मेरी कर ले रही हूँ, मैं मनकम बोल रही भगवान मौत भी कौन है बोल रही मारे, तो तू धराए मत करके काय कर रही है, तो थाना काय कर रहा है मेरी गड़बड़ कर रहा है।
Yeah, so retained earnings. So today's the concept retained earnings I have already explained you. Retained earnings is nothing but the company every year accumulates certain profits. A company every year accumulates certain profits in an account called retained earnings account, and like this accumulated profits, whatever the profits company earns every year, okay, as they are accumulating that profit in this particular account called retained earnings account, and whatever the dividends which would be distributed in the future will be deducted from this retained earnings account. Okay, so let's do an activity here. Activity 4 is based upon retained earnings. ABC company has following share capital: 1 lakh, 6%, $1 irredeemable preference shares. Okay, 2 lakh 50 cents ordinary shares. So there are the data is given here. There is 1 lakh, 6%. 6% shows the dividend which would be paid for the irredeemable preference shares. Okay, so if you see here, 1 lakh into $1, so there it is like $100,000 worth of preference share capital. Out of this, that means of this 6% will be given as dividends. So that is $6,000, right? Now 200,000 shares, and 50 cent is the value of each ordinary share. So the capital is $100,000. All right. Now what they are saying, retained earnings at the beginning of the year was $125,000. That means this is the opening balance of retained earnings. And then during the year ended 31st December 2000, it made the following profits. What are the profits? Profit before tax. So this is what they are saying at the end of the year. See, we started the topic from here, and the figures at the end of the year are also given to you. During the end of the year, or during the year ended 31st December 2007, it made the following profit. The profit before tax is this, income tax is deducted, and the profit for the year is this. Ordinary dividends paid and declared during the year were as follows. Interim dividend paid, that is this dividends are paid during 6 months time. Okay, final dividend declared on 20th Jan, 10 cents per share. Okay, this is the final dividend. So now what are we going to see? We are going to see the movement in the retained earnings for ABC company for the year ended 31st December 2007. Let's do this calculation. First, we will take the beginning of the year amount of the retained earnings in the outer column, which is $125,000 as given in the question. So what do you mean by movements in the account? We will see that at the end of the year, how much balance is left over in the retained earnings account. Okay. So profit for the year also they have given the column. You will be just transferring the profit for the year, which is 50,000 here. And then we have to see the dividends. We have already seen the preference share dividends, which is $100,000 into 6%, which happens to be $6,000. And we have seen the ordinary dividends. Ordinary dividends, let's see what is the condition for ordinary dividends. Each ordinary share is of 50 cents, and the ordinary share dividend happens to be 5 cents per share. This is interim. Okay, and final dividend final dividend declared on January 2028. So one more thing you should understand to confuse a student, they are giving 2008 date, but they are asking you the movement in the retained earnings for ABC company for the year ended 2007. What does it mean? You are not going to consider this final dividend part. Okay, because this is for the year 2008. We are only concerned, and we are only, we are only concerned with or what is relevant to us as per the data is only this 5 cents per share, right? Umayya, did you understand?
Yes.
Yeah, we are not going to take this 2008 figure. So we will take this 5 cents and the number of shares are 200,000. 50 cents. If I multiply $100,000 is the capital of that 5 cents. So how much that is going to be? Okay. 200,000. Okay. For each share, they are giving the dividends, right? So we are going to take 200,000 shares into 5 cents. See, one share they are giving 5 cents. So 200,000 shares they are going to give this into this. Okay, divide by this. So 200,000 into 5 cents. And previously also 100,000 was the redeemable preference shares into 6%. So when there is a percentage, see there are two things here which you need to understand. Here they did not give the per share how much dividend they are going to give. Here they gave percentage. Okay, so the difference between the irredeemable preference share and equity share as per this question is, in case of irredeemable preference share they gave the percentage, that is 6% dividends will be paid. Okay, so when percentage is given you have to find out the share capital amount. So here $100,000 into $1 is 100,000 shares into $1 is $100,000. Of that 6% it would be $6,000. So I'm showing you the difference. Whenever you get such kind of question whereby they are giving you number of shares here, okay, and they are not giving you per share how much dividends you are going to pay. They are giving you percentage of dividends. Okay, so in that case you need to find out the total share capital amount. So I am finding out the share capital amount, $100,000 into $1, that is 100,000 shares into $1, that is $100,000. Okay, I'll write here. So here I'll give you a clear idea. Irredeemable preference shares, percentage of dividend paid is given. Okay, so we have 100,000 shares into $1 per share. The capital is $100,000. Of this $100,000, 6% will be paid as dividends, $6,000. Okay, but in case of the ordinary shares, they have given 6 cents per share. So what we will do, we will take the number of shares, which is 200,000 shares, into 6 cents per share. So we will 5 cents, I think 5 cents per share. It would be $10,000. All right. So here percentage is not given. Here directly they have given per share how many cents will be the dividends. Here percentage is given. So we need to find out the capital and apply the percentage there. So ordinary dividends $200,000 into 5 cents happens to be $10,000. Okay. So the total dividend is $16,000.
Sir, 5 cents is 0.5, right?
Yeah, 5 cents is 0.5. Yes, correct.
So
No,
it
0.05.
should be
0, 0. No. 5 cents is 0.05.
okay.
50 cents is 0.50. 5 cents is 0.05. Okay.
Oh, yes, sir.
Yeah. So from the current year profits, this dividends would be deducted. So you can just calculate 125,000 plus 50,000 minus 16,000. Can you tell me the amount here?
Yes, sir. 159,000.
Just a second. Give me a second. Okay, just have a look through this completely. Umayya, once done, tell me. I'll be moving forward.
Yes, sir, done.
Okay. Then comes the long-term borrowings. Long-term borrowings are also a type of finance for the company, a source of finance. Company may choose to raise finance by issuing equity shares, and alternatively, it can raise funds by issuing debt as well. One way of raising long-term finance is for a company to issue loan notes, okay, also called loan stock or debentures. So already we had a discussion regarding what is a debenture or a bond or a loan stock or a loan note, etc. All mean the same. All are like almost similar. These loans usually carry a fixed rate of interest and have a predetermined redemption date. That means when you take a loan note, it will carry a fixed interest rate. So in this case here 10% is the interest rate. Okay, point number one. And it will also have a predetermined redemption date. So that means when it should be repaid will be clearly written or mentioned in the loan note. So like you see the example, $50,000 is the borrowed amount. 10% is the rate of interest on that amount. Okay. What, and they have clearly mentioned the meaning as well. Company will pay a interest of 10% on $50,000 borrowed each year. Okay, that means company has borrowed $50,000 from people, and company is ready to pay 10% interest on this amount every year to the people. So capital amount of 50,000 will be repaid in the year 2006. That is the maturity date. Next, finance cost. Everyone knows when you are taking a loan, you have to bear finance cost. That is nothing but the interest what you pay on any kind of borrowings or loan. And that is shown in the statement of profit or loss as finance cost, okay, as an expense. So the entry would be debit all the expenses in the statement of profit or loss, that is finance cost, and credit the cash account. Why? Because this is the decrease in asset. Decrease in asset is credit and increase in expense is debit. Okay, as per that the entry is written. Next, income taxes. So we are about to finish the chapter with more two topics. See, when it comes to income tax, everyone knows whenever you earn a profit in the company, you have to pay taxes to the government. So income tax is an expense and it is debited in the statement of profit or loss because income tax happens to be expense. Increase in expense is debit and increase in liability is credit. Current tax payable is the liability for you, and liabilities are always shown in the SOFP, statement of financial position, and expenses are always shown in the statement of profit or loss. Okay. Companies must pay income tax on their profits every year. This tax is payable after the end of the financial year. Companies must pay income tax on their profits, that is for sure. This tax is payable after the end of financial year. Yes, after the financial year ends, the profits would be out because the statements of the company will be made and we will be knowing what is the final result of the company's activities, what they have performed. See, whatever the activities performed is nothing but the trading or manufacturing, whatever. So the end result is what? The end result can be a profit or loss that you will be knowing with the help of the financial statements of the company. And once you know that, when is a profit, you have to pay tax. When it's a loss, you need not pay tax. So the financial statements will include an accrual for the director's best estimate of the tax due on the profit for the period. So you should understand one thing. Every company will make a provision for tax. Okay, that is the estimate made by the company for paying taxes. Okay, because no one knows what is the profit figure going to be, but they have an idea about companies like past performances, and they know in what range they earn profits, and accordingly they make some estimate. Okay, that's what they're saying. So this is a liability, provision is a liability. So the financial statements will include an accrual for the director's best estimate of the tax due on the profit for the period. That's the reason why here they have written increase in expenses debit, and again increase in liability, because you need to pay tax, right? So it is a credit. So tax is shown as an expense in the statement of profit or loss and current liability in the statement of financial position, and this is the entry for that. Often the actual amount of tax paid will be different from the amount that was recorded in the financial statements, because you pay taxes based upon your tax returns or income tax returns, which you will be filing with the tax authorities, and you'll be preparing it separately from the financial statements. So then comes, this is over or under provision. This over or under provision is simply adjusted in the next financial statement. See what happens. There can be a case whereby there can be over provision or under provision. Okay. So when this is the case, over provision or under provision, like the tax what you are paying is, let's say X amount, let's say $100. Okay, this is the tax what you are paying, and you have made a provision of $120. It's an over provision. When you made a provision of $80, it's an under provision, right? Now let's understand now this example. Lauren Limited has a year. Lauren Limited has a year end of December. When preparing its financial statements for the year ended 31st December 2005, Lauren estimated that its income tax payable would be around $62,000. That is the provision for tax what they made. Okay. But Lauren settled this tax liability on September 30, 2006, paying 65,000. So they made a provision of 62,000, but they are paying 65,000. The tax estimate for the year ended 31st December 2006 was 43,000. Okay. This is the next year. This is in the year 2005. So this is the previous year. Let me be very frank. So see, when preparing its financial statements for the year ended 31st December 2005, Lauren estimated that its income tax payable or liability will be this much. Next year has come. They paid this much taxes. Okay. And they closed the books in the month of December, it seems. And also the estimate of tax, that means this is the provision of tax, is 43,000 for year 2006. Okay. So what are they asking? Record the tax entries for the years 5, 6 in the ledger accounts. Prepare tax note which relates to the statement of profit or loss for the year ended 31st December 2006. So let's say income tax expense. We are going to find out this income tax expense. How are we going to find out income tax expense? So first we will take the opening balance. Okay. What is the opening balance of this? What is the entry for this particular amount? The income tax payable, income tax expense to income tax payable, right?
Tax payable.
So in income tax payable, it will be by income tax expense, 62,000. Now, this is for the year 2005, and we don't have any other figures for this, so we will close this account. Okay, we will to balance carried down. And again, this will be the 62,000. Okay. Anything else is given? Yeah. So 65,000 is in the year 2006, right? So 65,000 is what the Lauren settled this tax liability on 30th September 2006 by paying 65,000. So they had an income tax payable of 62 and they are paying how much? 65, right? Correct? 62 they had to, they like estimated, and 65 is what they are paying. So what is 3,000? Hello? That too in the month of September. In the month of September, they are paying 65,000. Okay, and their estimate was 62. So there is 3,000 extra payment happening. This is liability, right? This is the extra tax debt. So actually I'll write it here only. So this is like, I'll write the dates also. Income tax expense, SOPL 2 tax payable. Okay, that is income tax expense will come here. Okay, we did a wrong treatment actually. Sorry, I'll just open one more book. Yeah. First and foremost, we have to pass a clear journal entry for this. Okay. So the journal entry is 62,000 is for the year 2005. The entry would be income tax expense to current tax payable. So in income tax expense, we'll be writing to tax payable. That is on 31st/12/2005. Okay. Anything else for 31st/12/2005? Anything is there? No. So this will be again, this particular will be transferred to P&L also. Okay. So SOPL 62,000. Fine. Then what happens in the next year? 65,000 is what you are paying. So extra 3,000 is also the tax payable. So to current tax payable 62,000, 3,000. So totally by 39/2006 you are paying 65,000. Correct? Yes. Next one. What is for the year 2006? 43,000. So income tax to tax payable to current tax payable 43,000. Okay. And this is for the year 2006 as well, and this is also for the year 2006. We will be transferring this to P&L at the end of the year 2006. So 31st, this also I'll put here, 31st/12/2005, 31st/12/2006, totally 46,000. Okay, Umayya, is it clear for you?
Yes, sir.
Okay, so what happened? This much was the liability for you in the year 2005. In the year 2006, you have paid 65,000. That means this is also cleared, and this was a liability, right? And this much you paid extra. And in the year 2006, you also paid this much. So in the year 2006, you totally paid how much? 46, right? And that also you showed in the P&L account as an expense. So year 2006 entry would be SOPL, that is SOPL income tax expense. I'll write this in bracket 46,000, and to tax payable it will be 46,000. Okay, next. Then we will be also putting the things in the current tax payable. So whatever we wrote in the debit of this will be going in the credit of current tax payable. How? So like here we wrote, right? Income tax expense to current tax payable. In current tax payable by income tax, correct or wrong? Ledger. Hello. Yeah, see here the entry was income tax expense to current tax payable. In current tax payable, we'll be writing by income tax expense, right? Ledger account. Yeah, ledger posting. Yeah. So this was 31st 12 2005. Now this is the balance brought down in this. Okay, the entry is clear. Income tax expense to tax payable. So in income tax expense we wrote tax payable. In tax payable we'll be writing by income tax expense, and this is the balance at the end of the year 2005. Now we'll carry down this balance by balance carried down, that is on 31st 12 2005, because next year we have to bring this balance down in the year 2006, 62,000, and this account is tallied down 62,000. Again brought down, this balance will be brought down. So brought down balance by balance brought down, and the brought down balance will be on the first date, first 2006, 62,000. Okay, and again extra 3,000 also you paid, right? Here 62 plus 3 65,000, right? So in income tax, what we wrote here, income tax expense to current tax payable. So in current tax payable by income tax expense 3,000, by income tax expense 3,000. Okay, so now totally it would be 65,000. So sorry, here we will write two balance, sorry. So see, when we pay the taxes, the entry is current tax payable to bank. That means this liability which was in the credit now will go in the debit, because the liability decrease in liability because you are making the payment in the year 2006, and decrease in asset because cash is also going out, decrease in asset. Okay, so to bank we made the payment of 65,000. Okay, now in the final year, and that too we made it on 30/9/2006. Now what will happen? We will be again taking one more thing in the year 2006. Okay, 65 and 43. So again this is paid, right? So this has one more inclusion in this year. Okay, the inclusion is 43,000 income tax expense. Okay, so I will just strike this off. I'll write here by income tax expense 43,000, and this will be again we have to take it here to balance carried down 43,000. Okay, and then totally we have a balance of 1,08,000, and here 1,08,000, and next again next year by balance brought down we will start with 43,000. Okay, this is what is the total treatment. So this is what, once you can check it, Umayya, if any doubts you can tell me, we'll move forward. I'm waiting.
So can you scroll down a bit?
Yeah. Still I have to scroll down. Yeah.
No.
Once finished, tell me, we'll move forward.
Just writing. Two more lines, please.
Yeah.
Down a bit. Like
Yeah.
some more to write. And so,
Yeah. So they have asked this question. So we have done the first one. Second question, what they are asking is prepare tax note which relates to statement of profit or loss 31st December 2006. See, in this year, 43,000 is what is the estimated tax charge, right? And we had a liability of this much, and we are paying this much. So there was a under provision, right? Because we have estimated less previous year and we paid this much this year. So there was a under provision of 3,000. So this is under provision. This is tax charge. Okay. That means this year's estimate. So it's like 46,000 totally. Just make a note of this. Hello. Hello.
hello, yes, sir.
Yeah. This is the tax charge for the current year. Okay, and this is the under provision. That means this much is the income tax expense what we have seen as per the question. That means the income tax expense for the current year will be 46,000. Okay, shall we move forward?
Yes, sir.
That's what we have also calculated in income tax expense 46,000 from our previous account. This one. Just a second. This one. We did income tax expense account. This one. Okay, fine. Let's move forward. Already calculated that, right? This one, this goes to the SOPL, this one for the current year. Next one, comparison. See, comparison, what comparison they are making or drawing here? They are taking two companies here. They are taking two forms of business. One is sole proprietorship or partnership and a company. See, when it comes to ownership. Here there is a single owner. Here the single owner or the partners can own the business. Here the shareholders own the business. Liability, they have unlimited liability. They have to sell their personal property to dispose of their debts. Here they have the limited liability, and that to the extent of the investment what they have made, the shareholders. Legal status, the business and the proprietor share legal identity. Okay, although the business is a separate business entity for reporting business, that means sole trader or partners, they represent the business. Okay, and here company is a separate legal entity. It's separate from its shareholders. So the business and proprietors share legal identity. Okay, that means they are the ones who are owning the business. The business is with them. Management. See, usually the proprietors, they or partners, they manage the business. Here, the shareholders do not manage. The board of directors, the management manage the business. Profits are taken by them. The proprietor takes drawings out of the business. That means whatever the salary and everything they withdraw, it's drawing. So any cash amount taken as a salary are not an expense of the business, but drawings. It is drawings. Not, you should not consider that the salary what they are taking from the company. See, every sole trader or partners who are running a business are running for what purpose? To earn livelihood. Okay, so if they have to like if they have to run their daily needs, they have to fulfill their daily financial needs, expenses. See, they are also working for what purpose? For survival. Okay, profits will be at the end of the year. That's the end reward of the business. But a proprietor who is giving his full time to the business definitely wants some salary. The salary what he's taking out from the business is not really expense of the business. It is drawings. See, proprietor proprietor giving salary to his employees, his staff, is an expense for the proprietorship business. But if he is drawing salaries from the company, that is not a expense, but that will be termed as drawings. Okay, not an expense. Let me be very clear here. Everything is an expense. Okay, director's remuneration is an expense, but only the dividends which is shared to the shareholders is not a expense. Okay, taxation, business will be taxed. Here also income tax have to be paid on the profits. And here they make the statement of financial position. They show the capital, they show the profits are added to capital and the drawings are subtracted. Here also we already know the middle of the statement of financial position is split into share capital and reserves. And the partnership, the capital is shown in an account called capital account, and the profits and drawings in an account called the current account. So here there are two methods: fixed method, fluctuating method. So what they do is they show capital in one account in partnership form of business. You have done that in your intermediate as well, right? And whatever the changes happens in the business, like drawings and other kind of payments what they are making to themselves, they always show all the changes in the current account. Legal requirements, there are no legal requirements specific to a sole trader or partnership. There are a lot of legal requirements. They have to file the statements annually, and the business is closed to outside investors. Here it is open, anyone can invest. Okay, this is the end of the chapter, Umayya. Now I'll be coming to the status here where we are. So basically 1 2 3 4 5 6 7 8 are done. Next class will be taking preparation of financial statements of companies, chapter number 20. Okay, and we'll be taking events after reporting period and cash flow statements. I'll be finishing this 4. Okay, I want to conduct a test, Umayya. So will you be prepared for the test on Monday for first 6 on Tuesday for first 6 chapters?
Okay,
Hello.
sir.
Okay, sure. Okay, then done. So Tuesday I'll be conducting a test for you. Okay, Umayya.
Okay.
Okay, then afterwards we'll be going for the next topics. Fine. Thank you so much.
Thank you, sir.